Hey y'all, hope y'all doing well. Welcome back to another Saturday video, and I got a different one here for you. This one's been suggested to me sometime. I've been meaning to do a video on this actually for over a year now, and I'm finally bringing it to you. You know, because this fund is controversial. It typically pays an extremely high dividend yield, as you can see from the thumbnail and the title. So that makes it popular. But does it make it a good buy? Is this a yield trap? Can you make money with it? The answer is not, cut and dry. Yes and no. It's bad or it's good. It's not that cut and dry. And I'll kind of try to dig into it a little bit and try to explain what it is that it does and how you can possibly make money on it, and if it's good for income investors. Let's find out. So if you're new here, please like, share, subscribe, do all that good stuff. Down in the pinned comment down below is ways you can support the channel with all the affiliate links and all that stuff. All you guys that have done that, I really appreciate it. On this channel we talk about different income funds, different strategies, some options, different income ETFs, etc., etc. Goal for me is to retire with less, and I'm gonna buy a RV, not really a travel trailer, but that we saw that in Big Lots and thought it was kind of cool, so we bought it. But anyhow, that's what we do here. Appreciate y'all here, and let's get into it. So as you probably noticed, we're talking about ticker symbol CLM. That's the Cornerstone Strategic Value Closed-End Fund. Now, I know I say this in every closed-end fund video, but it needs to be repeated all the time. Closed-end funds are similar to mutual funds, but not quite. Mutual funds are open-ended, meaning you can always buy into it. You buy into it at its net asset value, or whatever the value is of all the holdings of the mutual fund. In a closed-end fund, it's a little different. The net asset value and the share price are disconnected. So the net asset value is what it is. It's the net asset value of all the assets that the fund holds, that the managers manage. The share price is essentially what me and you as retail investors bargain over, or bargain over to see how much you want to sell it to me for, or I want to sell it to you for, and how much you want to buy it for, or how much I want to buy it for. So it's supply and demand. So that's how the share price is determined. And what that creates is possibilities of discounts to the net asset value or premiums to the net asset value. And when I talk about that, this is what I mean. Now, we'll look at CLM here, and we'll see that it has a share price, current, $12.26. Its net asset value, though, is only $10.35. So currently it's running at an 18.84% premium to its share price, or to its net asset value. So you're paying 18% more, or almost 19% more, for $10.35 worth of assets. So you're paying $12.26 for $10.35 worth of assets. I hope that makes sense. Now, this fund typically trades, though, at a premium. You'll see the 52-week average right here is 19.42%. So it's always trading at a premium. And they had a 52-week high at one point, trading at 41% over its net asset value. And the low only got to, it was still trading at a premium at the low, and that's 8.8%. So what is CLM? Well, it's a closed-end fund that pays a really high distribution yield, distribution rate of 15.68%. super high. That works out to 16 cents a month, and it's paid monthly. Now, we'll look at the fund basics and we'll look at it. It's essentially a buy and sell type of fund, right? They're looking for growth and value stocks in U.S. and non-U.S. And they also invest in preferred stocks, rights, warrants, securities, securities convertibles, and it has consistently maintained the investment of at least 95% of its assets in U.S. listed companies since June of 2001. So it's mainly a U.S. equity fund, right? It will invest some into some other closed-end funds if they're trying to get exposure to like master limited partnerships or energy or real estate or things like that. But it will mostly hold stocks. So right now it has $801 million in total investment exposure or common assets. Common shares outstanding right now, 77,475,000. I'm not sure if that's completely accurate, because I saw something else that said it was over 100 million, but maybe I'm mistaken. Now, mutual funds and closed-end funds, they typically have higher management fees because they are not passively managed. They don't follow an index, right? It's not just, okay, we're going to buy the S&P 500 and that's it, right? They are constantly managing a portfolio day in and day out. And for that, they get 1.14% of the net asset value of the expense ratio. So let's look at real quick distributions, and this will be a little disappointing. You'll see it used to have a huge distribution back in 05 and 06, and it's just kept trending down. And this will come into play a little later. But it currently pays 16 cents a share every month. Look at the portfolio characteristics. Like I said, if you look at the top 10 holdings, it's going to look like, almost like an S&P fund, right? Amazon, Apple, Google, Microsoft, Procter & Gamble, JP Morgan, Walt Disney, Tesla, MasterCard, and they got a closed-end fund there. So that's CLM in a nutshell. That's what it does. Now, when I talked about net asset value, this is where it gets a little fuzzy, right? Some people have made money in this, and you could actually make some money. You can grow your portfolio with this, but look at this. Look at this price action. Okay, this is from inception, which was 1987 or 89, something like that. And look at this chart. It was $128 a share. At its peak, before the tech bust in 2000, it was $272. It massively took a hit down to about, 87, somewhere in there. And then it rolled along. It did okay for a little while. And then 2008 came, and it took a massive hit again. And ever since then, it's been just straight downhill. So, you went from $150 to $11. But people still made money in this. How? I'll tell you how. Right here. Normally, closed-end funds do not issue shares. It's very rare that a closed-end fund will issue shares, a rights offering. BST, which I did a video on a month or so ago when they did one. I'll link to that to explain that a little bit better. You can watch that. But basically, they're issuing new shares, and current shareholders can buy those new shares, and they can buy them at 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 a little bit over net asset value. Okay, so how does that work? Well, remember, right now it's trading at a premium. Okay, so it's trading at an 18% premium. Now this rights offering was a few months ago, so it's not going to be exact, right? Well, if they're selling it at just a little bit over net asset value, so you'd be buying shares at say $11, while the share price is $12.26. So it's kind of an instant arbitrage, if you will. You can see if you look at this, May 17th, 2021, 1-for-3 rights offering, which expired on May 14th. The offering was oversubscribed. So a lot of people did this, okay? So if you own the stock, you were entitled to purchase 1 share of common stock of the fund for every 3 rights held. The subscription price for each newly issued share was determined to be $10.64. And it was equal to the greater of 107% of net asset value per share as calculated at the close of trading on the date of expiration of the offering, and 80% of the market price per share at such time. So you instantly got a discount. So you could have absorbed these shares and now you're up 10% or whatever it was, right? All of a sudden. So you're lowering your cost basis tremendously by doing that because it's trading at a premium. So that's how they do it, and they do it quite often. So that's why you see the share price just dwindling and dwindling and dwindling, is because they're selling new shares at a lower price, and it's just they can't keep up with the drag. That's why you see the income going down as well, because they have more shares to pay out income to. So if they have more shares to pay out income to, they need to earn more money to cover those shares. And if they don't earn more money, they're just going to have to cut the distribution. That's why you just see that distribution just slowly going lower and lower. So could you make money if you reinvested dividends over the life of this fund? The answer is yes, absolutely. Watch this. We're here at Portfolio Visualizer. I'm using Portfolio Visualizer because the ETF channel one that I used to use, it's kind of wonky. I don't know if there's some tickers that I put in there that just make 0 sense as far as numbers wise. So I'm going to switch over to Portfolio Visualizer for a while and see how that works out. So what I have here is Portfolio Visualizer, $100,000 invested at the beginning of its term, as early as it goes. We're not going to withdraw anything. We're going to rebalance annually, but there's no rebalancing because it's just one holding. And we're going to reinvest the dividends. We're going to display the income, and we're going to compare it to the benchmark, which is the Vanguard 500 index, just the S&P 500, plain S&P 500. So we have CLM in there at 100%, and let's click Analyze Portfolios. And what do we see right off the bat? This goes from January 1989 to July 2021. Your final balance after reinvesting all dividends isn't bad. Your $100,000 grew to $831,433, which is a compounded annual growth rate of 6.72%. That's not horrible. It's not great, because if you consider the Vanguard 500, the S&P 500, that same $100,000 turned into $3 million in that same time period. So, that there's that. But you can see the volatility here too. Its max drawdown at one point was 72.74%, and that was from July 2007 to November 2008. The drawdown recovery didn't happen until August of 2020. So it took you 12 years to recover that 72% drawdown. As far as the S&P 500, it didn't do as well either. That was 50.9%, 51% basically. And that was pretty much the same time period, November 2007 to February 2009. Drawdown recovery by August 2012. So 3 years, 3.5 years. So, portfolio growth. This is the CLM in blue, and it's grew. I mean, but what's fascinating though is the amount of these drops. Like, look right here, 472,000 you had invested, and in 2 years it went all the way down to $202,000. Then it came back up. You got up to $651,000. And then in the 2008 crash, it went all the way down to $177,000. But it still recovered. And you're up to $831,000 now. So decent, right? So let's look at income then. Right? Look at this portfolio income. It's amazing. And this is not participating in those rights offerings that I was talking about. This is just putting $100,000 in and reinvesting dividends throughout the life of the fund. And look at these dividends. Look, 1 year you got $98,000 in dividends, right? These are all reinvested. $50,000, $55,000. You only put $100,000 in. $78,000, $87,000. I had a cut in 2008, so your income went down to $58,000, and it's grown since then because you are constantly buying shares. You're buying $89,000, $87,000 worth of shares every year. So I can't imagine, it doesn't show you how many shares, but you have a lot of freaking shares in this thing. In 2020, you got $127,000 in income. I shouldn't call it income. I should call it a distribution, because just watch. So what if we took that $100,000 and we took income from it, right? So we're here back to $100,000. Reinvest dividends, no. And let's just take cash and see how it works out. We'll do the same thing with the S&P 500. So now your $100,000 has shrunk to $10,000. You've lost 6.8% per year by taking the income. And if you can see there, your portfolio growth, you started at 100,000, you got as high as 206,000 in 1999, and it's just been, if something's going to zero, this is what it looks like, right? But look at the income. Let's look at the income. Look at that income. So you had a decent amount of income in 1999, and then after that, it's just going down and down, and now you're only getting $950, or $1,800. The year's not over yet. 2020, you only got $1,800, $1,900 in income off your $100,000. So how can you use this to get income? Does it, if you have to reinvest it to maintain, what does I don't understand, unless you're doing the rights offering and really surpassing your income needs and really ramping up how much you own in this, and you're able to reinvest a huge chunk to keep up with the income, with the distribution drop, and participate in those rights offerings. I don't see how this turns out very well. Because watch this. Look at this. Let's go to the metrics here. I found this interesting, and I added this all up. I have it calculated. Let's go to the metrics. And let's look at annual returns. Let's ignore the Vanguard 500. Let's just look right here, right? So, and look at all this income that you reinvested into CLM over the years. Any guesses on how much that income was? That income was $1,692,345 that you received and reinvested into CLM, so that at the end of the day, your final balance is $831,433. So almost $1.7 million in distributions reinvested into CLM, along with the $100,000 you started with, is worth $831,433. That's insane. That sounds insane to me. So I just wanted to throw this out here. That's it. That's all I got. I wanted to throw this out here because I know there's a lot of people. I see a lot of people saying, "Oh, I'm buying CLM. It's paying, at one point it was paying like 22% yield." And I'm like, yeah, it is. But what's the end game? What's the end game here? Are you really going to, have $1 million into this fund that historically has performed extremely poorly, dilutes the shares, and decreases the distribution consistently? Are you really going to do that? Because you're going to need to outpace. I don't have the numbers. You're going to have to outpace your income need by a huge number to prevent your income from going like this, right? Because over here, this is a nice income stream growth, right? But you can't spend any of that. Now, what happens if let's just say you took cash flows, you withdrew a fixed percentage, say 4% a year, right? Let's annualize that. So now your $800,000 is now $225,000, and your 4% income, it's not doing too bad. $35,000, $33,000, but it's not great. It's not great, especially considering this is for since 1989, right? So anyway, that's CLM in a nutshell. Can you make money on it? Yes, you can. If you participate in the rights offerings, you reinvest the dividends, and you do that, you make money, because usually you're buying, and a rights offering, you're buying at a discount. But what's the end goal here, right? How are you gonna live on this? I can't fathom how much you would need to generate a large amount or a decent amount of income while protecting your capital and growing your income. I don't have the numbers for that. I'm not going to waste my time trying to figure that out, but that's CLM. Hope you guys enjoyed. Like, share, subscribe, do all that good stuff. Leave me a comment down below. You guys have a great weekend. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.